Welcome to Inside Startup Investing, the only podcast where you can invest in every guest. On this episode, I will be speaking with the founder and CEO of Doc2Doc Lending, Dr. Zwade Marshall. Doc2Doc Lending is a specialty fintech lender focused on meeting the very unique financial situation of medical professionals. You see, while all of us think of doctors as highly successful professionals with really high-paying jobs, the road to get there is a long and arduous one, often over a decade long between medical school and residency. During that time, most rack up hundreds of thousands of dollars in debt and get paid practically less than minimum wage during their residencies. Hence, this leaves many up-and-coming doctors in a precarious financial situation as they are getting started in their careers. Few lenders are willing to lend to them based on their traditional FICO score standards, and that is where Doc2Doc Lending comes in. You see, a few things that stood out to me about this company are first, this business was started by a doctor himself who knows the pains and struggles experienced by medical professionals as they transition from being students to actual doctors. He himself left school with hundreds of thousands of dollars in debt and knows what it's like for doctors trying to get their first apartment and home in order as they are getting their first job. The second thing I love about this business is that FICO scores are not the end-all be-all. They are a blanket tool that enables lenders to make quick decisions, but there is so much more nuance to an individual than a FICO score can ever tell. Doc2Doc Lending is leaning into the inefficiency of a FICO score to provide a much-needed service while still minimizing its risk. You see, their credit model is built on a resident in a medical program having a letter matching them to their first real doctor job that will come with an outstanding outcome. They look at the future rather than looking at the past, where the customer was in school for a decade, unable to build a real FICO score. And lastly, this team has provided over $100 million in loans to date and has raised over $20 million to grow the business from other doctors who also understand this unique financial challenge. The unmet need is clear, the ability to deploy capital and drive a return on investment has been proven, and the team in place is outstanding. So with that, let's get on to the show and welcome Dr. Zwade. For those who don't know you, can you dive in a little bit on your background as a doctor and how you came to found Doc2Doc Lending?
Absolutely, I'd be happy to. I'm wearing my costume today. I'm actually in the clinic. I'm an interventional spine doctor, anesthesiologist as well. So I'm double board certified, and I treat patients with back pains. I did my initial medical training at Emory in Atlanta. And then went on to Harvard to do my anesthesiology residency and fellowship. For those unfamiliar with the medical training programs, it's really about 12 years of schooling that can feel very painful because it's the time in your life when your peers are, buying their homes and starting families, and we're still toting a backpack around going to libraries and working, 80 hours a week. And so that journey going through the medical training into residency and fellowship is one that I personally experienced the financial toll that comes with it. I had $200,000+ in student loan debt, which is a little bit below the average for a doctor. I had income as a first year at Harvard of $13.12 an hour in payment, and then my FICO score was in the mid 600s. And what that means is when you're looking to access capital, you're looking to borrow money for relocation, for life happens, your basement floods, your car breaks down, whatever it is that comes up in that when you're 20s and 30s. We just can't borrow money affordably because the banks see us on paper as being high-risk borrowers. And so we're the ugly duckling in our 30s, and then we blossom into beautiful swans in our 40s and beyond when you've got a career in medicine, and everyone will lend to you then. That's the mismatch that we're solving for, in that we understand the doctor's career cycle better than most and can serve their needs with the timing of our loans to be more thoughtful about how to underwrite them.
So when folks are coming to you and sourcing loans from Doc2Doc Lending, what is the main purpose? Is it to pay off student loans? Is it to buy their first home? What does that look like?
Yeah, great question. So it's definitely not student loans or mortgages. These are consumer loans, right? Smaller loans. So the max is $100,000. And the most common reason today is debt consolidation. Because of the way interest rates have been and because of our kind of career arc, the easiest way for us to pay for those life happens expenses is swiping a credit card. So we've got a 30% APR that's accumulating over time, and it's dragging our FICO scores down. So we're helping doctors get out of that credit card debt into a lower interest installment loan to kind of stabilize their finances. The second highest reason is transition, because getting into residency or your first job after residency is like being drafted, right? Like, so when I was at Emory, I applied to 10 different anesthesia residency programs all across the country. I interviewed all 10. And unlike a traditional job interview where someone likes you and gives you an offer on the spot or some weeks later, there's a match process where a computer algorithm will match each applicant to a residency program with each medical student that interviewed at that program. And on this singular day, it was March 17th this year, all students around the country will open up an envelope with a letter that says, you have matched into Harvard or USC or South Carolina State, whatever it is. It's all there. And now you've got to figure out in that moment how to get from Ohio to Nebraska, California to New York, and you've got the expense that goes with that. And so they'll borrow for that we call a transition loan, going from point A to point B. That's the second highest reason.
Getting your, paying for your new apartment, all the furniture you may need, getting across, quite literally moving your stuff to be able to go set up, that kind of stuff.
Absolutely. And God forbid if you have a family, right? If you've got a husband or a wife and kids, there's that additional expense. We're seeing a higher incidence now of our female colleagues, the female docs who are doing longer residency programs. Think of like neurosurgeons. I mentioned 12 years is the average time that doctors spend in school post high school. It's more like 18 years for a neurosurgery resident. Well, those women are trying to preserve their fertility. So a pretty common use case now is oocyte cryopreservation, so freezing eggs, and also fertility treatments as well. It's a $30,000 to $50,000 expense, and folks are borrowing for that also. So there's a bunch of like unique niche needs. Like student loans are well known, and there's a huge market for that already existing. Doctor mortgages, also a pretty mature market with a lot of banks like Truist and Regions Bank that offer products for doctors. But this life happens in between, or I need $30,000 pretty quickly as a doctor, is where our gap is, and that's where we're filling it. Now, it doesn't mean to say that in future, as we grow the company and begin to serve more of our doctors with this loan, because we own the data, because we know their payment history, because we know their specialty and their income, we can offer the next second, third, fourth product that we know they'll need. Or we have a just under 30% repeat customer rate, meaning someone borrows some money from us, they borrow maybe $15,000 for the relocation, they'll pay it off and come back to us in 2 years and ask us to lend them again because they need the equity capital for their buy-in to their practice. So we've got the reps in now, having done this now for 5 years, of folks that are saying, can you guys recommend a good mortgage company for me? Can you help me figure out my disability insurance? Do you know a good provider for med mal insurance policies? So we aspire to be the USAA for doctors, where if you're a doctor and you need a financial product, you think about us first. If you've experienced our service, it felt empathetic, it was timely, we met them where they are, in the sense that many of us are so busy we can't go into a bank and apply for a loan and give them pay stubs and the like. We do our entire process virtually on nights and weekends as well. So it's all meant to be a process that meets the doctor where they are when they're there, with a frictionless process to get them to apply, approval in minutes, verification within a couple of days, and then disbursement within a week. And so it's all meant to be pretty frictionless from beginning to end.
It feels as though there's kind of two areas and reasons why lenders don't want to lend a product like this to doctors or soon-to-be doctors. Is one, the risk associated with them not having as big a credit profile, and two, that they aren't making very much money right now. So when do you become willing to lend to these folks, in residency or post? And then how are you building out the payment structure to make it something where you feel as though you can get paid back on a, fairly consistent basis, 90+%, so your default rate isn't high?
Brilliant questions. Clearly, you're someone that's used to investing and understanding how companies work. That's the crux of the matter here, to your point, Chris. It is assessing when within that doctor's career cycle that they're most apt to being able to repay a loan. Our determination is when they've matched into residency as a fourth-year medical student. So you've got to have that match letter in hand, and it's got to say that you've got a position somewhere. There is a portion of med students that will unfortunately not match. If you're applying to a competitive specialty like dermatology or plastic surgery, there are 2 spots per program, and it's just hard to get in. And so those folks that don't have a seat at the end of that musical chairs will not have a job. So we're lending to 4th years of match. That way we know they've got guaranteed income. And we're also lending to them right before they need to spend money to move. So it's timely for us because they're eligible for a loan, and I know they need the money at that time, right? And then further on, now we have flexible payment terms where if you are a matched medical student or in residency, you can pay interest only for the first 30 months of the loan. And then as you mature into a fellowship and your first job, you can pay principal and interest. We have no prepayment penalties. So we tell our borrowers, if you have the ability to pay us off sooner, we actually encourage it. If your credit profile gets stronger because you borrowed from us, paid off your credit cards, you got that FICO bump, we don't want you to leave and go to SoFi or BHG because now they'll finally lend to you. We'll refinance you in seat and you stay with us. And we'll tell you, hey, we noticed that your credit profile is getting better. And so you'll go from a 16% loan to 13% with us. So we want to preserve our customers' ability to kind of mature because we don't just want to be known as the subprime doctor lender. Sure, we'll lend down to a 600, but we've got a robust part of our portfolio that are the super prime 800 plus doctors as well.
In terms of what your success rate is look like, getting paid back, what does your default rate look like, and what have returns on invested capital look like?
Yeah, so that's great. And I love talking about this because this is a part that makes us stand out as an early stage company. So if you compare us to SoFi, is the gorilla in the field. They are the belle of the ball. They've got a beautiful enterprise valuation because their model, and we really copied them in how they built their company profile. They're giving loans to graduates of elite schools. It was student loans at first to Stanford grads, and their customers were going to mature into having good jobs, 6-figure jobs, and buy big homes and big cars, and could continue using their products. While SoFi, on their consumer lending part, will only lend down to a 680 FICO score. And when the markets tightened up, it was down to a 720. We lend down to a 600 FICO score. SoFi has to publish their data because they're public, and their default rates are the 3.87% range. Ours, 2.23%. And that's really over the course of the last 18 months that we start to see some strain as the markets got really challenging for consumer lending in the last 18 months with rates doing what they've done. Historically, we've been at sub 2% defaults with a subprime population that should be defaulting closer to 7% of the time. So we've seen that preservation there. Because there's this risk-based pricing mismatch, though, we're able to extract higher interest rates for their risk profile than you could otherwise imagine there would be. So our gross yield is 16.5% on our portfolio. And so it's healthy enough to allow us to have gross yield minus defaults and still make a margin if we have the right kind of capital stack and cost of funding in place.
So in terms of your kind of revenue business model, how do you make money? Is it just on interest that you create from lended money, or are you also getting transaction fees, origination fees? How does that work?
We do get interest spread, and that gets compressed when rates are high like they are right now as our borrowing costs go up. But we're able to get origination fees, so we charge between 0 and 2% in all fees up front. We also get paid servicing fees. And what does servicing mean? It is that we maintain the borrower relationship. We're the ones saying, hey, Dr. Lustrino, you owe us $200 this month. We send the communications to them, they pay us, and then we then remit payments to our investors and funding partners. So our partners pay us a servicing fee to have those transactions occur. Then we've got some referral rapport in place with some other companies out there, where if someone asks us for a mortgage and we send them to Truist, we get a referral fee from Truist for making that referral. And so we're testing other products with partners currently to see where the energy is within our portfolio, to then bring it in-house and start our own in the near future.
From the perspective of the dollars that you're actually providing to these clients, it seems like you have a debt facility. You've maybe raised some equity capital as well to be able to lend out. Who are these debt facility providers? And then, what are you borrowing at? And then on top of the interest that you're putting there, and basically what is your margin on lended dollars?
Published on our site, DR Bank is our bank partner. They're our originating bank, and they also retain assets, meaning they buy assets from us and hold them in their balance sheet and pay us to service those assets. We've got a credit fund in California. They're called Rivonia Road Capital, and they're a fantastic group that's been a really good partner to ours. And they buy the assets from us when we originate it, and pay us to service them as well. And so that's been a very fruitful partnership. We historically had a credit facility from a local to Atlanta company called Encina Lender Finance. We sold that portfolio last year as interest rates began to rise, and we're in the process right now of renegotiating to have a new warehouse facility in place as rates have now stabilized. The company is now bigger, and the terms can be more attractive. I said a lot of words. I want to make sure that the listening audience understands what that all means. So we're not using equity capital to give loans. That's a poor use of equity capital. If you're gonna, raise money, and it's so expensive to give a part of your company to then lend it out at 16.5%. Equity capital is growth capital. It's capital that helps us to grow the team, to acquire customers, to innovate on products, to fix our tech stack, etc. We actually lend from borrowed money, and we benefit from a spread, or we'll originate a loan, sell the asset to a partner, and have them pay us to service that loan. And so that's really how we make money here. And so we're proud of the fact that as an early stage company, we've been able to convince sophisticated investors and big partners to give us $150 million worth of lending capital. So that's the capacity we have for growth. We're doing about 50 to 60 million in loans annually now. We're in that kind of a run rate. And so we've got room to grow. And what's our challenge now is to make sure we can grow the market and look beyond maybe just doctors and other health professionals with a similar profile to doctors to deploy even more capital and grow the company in a disciplined manner.
What has been the customer acquisition strategy to get these doctors? And when you talk about growing beyond, what does that mean? Just to other healthcare professionals, or do you want to go beyond the industry of healthcare in totality?
So sure, I'll begin at the end. Definitely don't want to go beyond healthcare. Like, that's what we know. The company Doc2Doc, the name speaks to us being able to acquire folks who understand the journey of a doctor, right? But what does it mean to kind of grow beyond? Our thought here is there are other health professionals. There are folks that look like doctors in terms of a long training program, an expensive sojourn through school, depressed incomes at a certain point in their lives that then blossom into being more. Nurse anesthetists, for instance, have a similar kind of expensive training ground, but they'll make on average $220K when they graduate, right? We want to work with them. Nurse practitioners and PAs, physician assistants, doctors of pharmacy, veterinarians, all health professionals that increase the market from being about 7 billion to 17 billion if we could expand to other allied health professionals that look like us on paper. So that's how we think about expansion. Now, the other part of your question was, how do we acquire customers? What's been most helpful to our group is the affinity partnerships. Is being able to speak at medical schools. In the course of the last 8 weeks, someone on our team has visited or spoken to over a dozen medical programs, helping doctors understand the financial journey, giving them some bit of education around being thoughtful about budgeting, looking beyond interest rates, understanding what a prepayment penalty means, how's an APR and an interest rate different. And so these schools invite us in to help to educate their students on finances. And I'm there not as a CEO of a lending company, but as a peer, as someone who's gone through the same schooling, who now owns his own practice and can give friendly advice. But by the way, guys, I have a disclaimer slide that says I'm the CEO of a lending company. and I gotta disclose it as conflict of interest. And you see the entire room of students take out their cell phones and do this, and then we see the traction on our website activity go up at the same time. So it's really a benevolent impact investing bit where we're helping to serve the servants. We're teaching doctors how to think about money and then giving them loans at rates that make sense at terms that are very attractive to them.
Before you existed, is the bulk of these like transition costs, for instance, just going directly to high interest credit cards? Is that the bulk of what they're using right now?
That's the main competitor is credit cards. It's family members. So we kind of bite the bullet and go back to mom, dad, aunt, brother, sister, or the spouse who's already working and asking them to kind of help us go. It's funny that when I talk to most of our investors today are physicians. We've raised $21 million in equity from doctors that comprise 97% of those checks. And when I tell the story about why we exist and how we've grown, they all do this.
Yeah,
and they all kind of like, yeah, they get it. And then when I talk to bankers who have physicians in their family, they're like, yeah, I was the one that loaned the money for that rental deposit. I know exactly what you mean. And so it's this kind of like a pain point that unless you know, you don't know. You know, like if you're tied into the community in any way, it really resonates. If you're not, you're kind of shocked that doctors have this burden, and the person that you think is, you know, superwoman, who appears so confident in that white coat and can diagnose your kid's rash pretty quickly, has this secret that she or he is likely very embarrassed about. Their credit scores is in the dumps. They're paying through their nose in interest rates for their credit card debt from college and medical school, and they're secretly ashamed of it. We help our physicians, when they apply for a loan from us, they can speak to a doctor on our team who says, welcome to the family. Here's how we can help you understand your debt and your finances. And a sizable proportion of our borrowers do not want to talk to anyone. They want to apply for that loan in the middle of the night and just kind of go away into the sunset because they're just embarrassed. And there's a level of shame that we have because we're used to being overachievers. We think that that it's unfair that we've had to be saddled with this kind of debt and the subprime FICO profiles. So some of us are kind of suffering in silence and just trying to get out of it slowly.
It sounds like based on kind of the credit facilities you have in place, you could almost triple the business from where it is today, around 40 to 50 million in yearly loan origination, to close to, I imagine, around 150 million. When you think about what success looks like over the next 2-3 years, where do you see ending up in terms of loan origination volume and growth?
Yeah. So our target is to be at 100 million in origination volume over the course of the next 18 to 24 months, having a pathway to that number. And so being able to expand our product evolution and product pipeline to offer the products, whether it's a payroll-linked loan to nurse practitioners and CRNAs, it's expanding our TAM by having those allied health professionals who we know need access to capital that look like doctors and getting them on board as well. It's getting deeper into our current market. I think we've scratched the surface. We're currently lending to about 3% of the transition consumers that are looking to access capital. We can certainly get a lot more of that marketplace by getting more brand awareness and exposure. We're kind of like the secret that only the doctors know about. We've only kind of marketed in our community. And so getting deeper there is going to make a lot of an impact on us. And then it's being thoughtful about what are the next products that our doctors need. For instance, this is a consumer loan that goes between $5K and $100K. But we probably get more calls from existing customers about the commercial loan as well. I need to buy partner shares into my surgery center. Can you get me access to $350,000? And being able to innovate a new product that's like that with all the regulatory nuances that comes with lending for a surgery center buy-in. It's not a loan that most bankers understand because there's really strict regulatory considerations for anti-kickback, anti-Stark, and all the Medicare financing rules that we happen to know well as doctors, and we can help to support that product.
For those investors who are kind of on the line, I'll give you the last word here. What do you want them to know? What would you say to them?
So I think thank you for listening first and foremost, and I appreciate any support you get. If you know a doctor that you think may need some capital, mention us to them. But know that as a startup, we've been really good stewards of our investors' capital. it's really hard to raise money and grow a lending company in the prior 3-year economic environment. And we've inspired the confidence of our investor base and our institutional partners over the course of the past 3 years. We've paid out over $1 million in dividend payments to our partners, and we've never had to withhold or forego or skip any payments to any partners ever in our company's history. We're continuing to grow at a time when some consumer lenders have gone out of business. We've been able to adapt, change our pricing model, ensure that we got very disciplined in our expenses as well, monitor our cash burn in a way that continues to help us to thrive in this marketplace. We're proud that in the consumer lending for doctors space, we're beating our competitors who are better funded than we are, because we can relate to the borrower in a way that the others cannot. So it's really the for us, by us product. I'm the face of it. I'm the CEO and the co-founder, but I also want to let you guys know that I am not the engine behind getting the sausage made. We have professionals. My CFO, Chris Kronk, came from Bank of America Merrill Lynch, built a career there, left as a managing partner. My head of product came from Synchrony Bank and GE Capital. My head of strategy came from Kiva Lending. My CTO came from Fairbank and Kiva. So we've got a team of professionals who are not moonlighting as lenders. They're actually real lenders, but they also subscribe to the mission and the vision of helping to serve the servants. And we're thrilled. The last thing I'll say is we're thrilled about our Trustpilot reviews, that the folks who've used us love us. The reviews are outstanding. And if you read just the snapshots of what they say about who we are, it's exactly who we aspire to be. They're empathetic, they're fast, they're reliable, they truly understood me. They made the process easy, seamless, quick access to capital. It's all the things that we want them to say, and they're saying it about us on their own. And our referral process from customers has been brilliant. And we're also now seeing early borrowers becoming investors now that they begin to make their money. And so it's a beautiful story that continues to help our community, and we're thrilled about that as well.
If you like what you heard on the show today, you can check out why Doc2Doc Lending received a 3.8 out of 5 and an investment from Kingscrowd Capital at kingscrowd.com. You can now invest on Start Engine until July 30th, 2025. And please like, subscribe, and share our podcast wherever you listen to podcasts so more listeners like you can find us. Thanks for listening.